All right. Well, good day, everyone. Keith Allen from Material Indicators here, getting ready to start our live stream. Today, an intro to market making. We're going to learn what market makers really do, what they earn, and whether you should consider even becoming one. Joining me today, one of my partners here in Material Indicators, co-founder Frederic Schneider. We call him Fred, or the mad material scientist, and someone who our community is very familiar with, XBT3D, aka, and here's the big reveal for everybody in our community. His name is Shaun, and Shaun is joining us today as well. So before we dive into this, guys, first of all, welcome, Shaun. We appreciate you taking the time to join us here. And it looks like we are starting this just amidst some major volatility. So we might want to consider speaking to that for a moment here. Let me just clear my screen here and make sure I got this this working right, so we can see ourselves, or those of us who can be seen. Looks like I have a little bit of stuff on the screen here. So let me just clear this out real quick. There we go. It just ended. Beautiful. So, hey, Shaun, thanks for joining us. Thanks for, taking the time to share your knowledge with us. And Fred, you look great as normal.
Hey guys, how you doing?
Fred is in a secret underground lab with no lighting, so he's.
I've always wondered what's in that beaker.
Yeah.
Maybe I've watched too much Breaking Bad. I don't know.
Right, I was corrected early on. It's a flask, I was told, and the question is the flask half empty or half full? Seriously, guys, let's we're going to dive into the subject matter here. I just want to take a quick look because we are obviously seeing some market volatility take place. I'm going to pull up a fire chart real quick, and we'll take a quick peek at it, and then we'll dive into maybe get your perspective on this, Shaun, and commence with the subject matter at hand, which is, of course, market making. So let me share a screen real quick and go with the Fire Charts web app. And assuming you guys can see that there, it looks like, as we can see, price has dropped down, and buying has commenced by just about all classes, it looks like. Shaun, I know you study this market, of course. Fred, you're always watching as well. What were your expectations? Anticipating this pullback in price, and where we might find our footing.
I guess for me, I think I posted a few charts, and again, I'm going to self-declare here that I'm probably the worst person in the history of Bitcoin to actually call price movements. But I do think that for me, we need to pull back to, I'm going to be controversial here, and remember, I'm a long-term Bitcoin, but I just think we need to retest at least 20, potentially 13.8, and I will be a real believer in this bull market. Is that from 42? I don't know. But I mean, this is an incredible run, but it's parabolic. You can argue that the dynamics are different and institutions and so on, but I love to see pullbacks. I think it's incredibly healthy for Bitcoin in the longer term.
Yeah, especially if it finds its footing and maintains some bullish structure for those of us who are macro bullish. Fred, any surprises for you?
I'm just trying to play the levels here. Yeah. That was obviously at 40K, right? And once we took that liquidity and it was replenished, we started dumping, and now we're actually on some medium level support at 36K, and we see some mega whales buying. So that's orders in between $1 million and $10 million. And other than that, we have support at 33K.
Well, we'll see. We'll see if this current level holds in the 35 range, or if we go into a, well, it already hasn't. It's already broken, it looks like. So we'll be heading perhaps into a weekend range here. So let's go ahead and get into it. Looks like we have got already some regulars from the community joining us. So welcome Veronica and Jonathan and Anonymous and everybody else who's joining along here. We will have an opportunity to maybe field some questions from you guys as we work our way through this. First, a bit of housekeeping here. Of course, we are not financial advisors. Trading is risky. Nothing we say, do, or share should be interpreted as trading advice. Consult a financial advisor. Do your research. Never risk more than you can afford to lose. And past performance, definitely not indicative of future results. If you like the content, we hope that you will comment, like, subscribe, share it, and help us grow. Really makes a difference, really helps us out. And of course, we've got some tools that we hope you find some interest in. You can find links to those in the description. And of course, our community is everything. We've got such a phenomenal group of traders from around the world sharing ideas. This is not a moon boy space. There's no shillers. All those people get banned immediately. This is really a great group, a great community, place to share insights and gain insights, and we hope that you'll come join us there. So, as promised, we're talking market making today, and we've got a veteran with us, been in this game for a long time. You know, you're not looking very wet behind the ears, Shaun. So, how long have you been in this game?
I was introduced to Bitcoin by my son back in 2010 when he came to me and he went, "You should have a look at this thing." And I looked at it and went, "Well, this is like clearly never going anywhere." And I 100% looked at it and went, "This makes no sense, magic internet money and so on." But I did a small amount of research, and I'm not going to claim that I did a huge amount. And I like the politics behind it. I like the basic concepts, not just of limited supply, but that, you know, it's your money, do with it as you will. So how I started was I actually started mining, but not, and again, you know, hindsight's a wonderful thing. I'd love to sit here and say that I saw great value in it and blah, blah, blah. As far as I was concerned, I was donating some computer time to what I thought was a cool project. If I knew what was going to happen, I would have bought, you know, 100 computers and mined the hell out of it. But I didn't. And then I got I stepped back from it because I actually ended up donating computer time to a different project. And then I started mining again with S5s, if anybody, Antminer S5s, and then replaced those with S7s. And then I got caught up in the hype of 2017 and built a big GPU mine, which was really profitable. And then 2018, and I started trading actually only really in 2017, and algorithmic trading pretty much solidly since then. So my position on Bitcoin, and again, anybody who's in the group, and by the way, the group is amazing, credit to you guys, is that I'm always spot long. I trade against that, and I earn my beer by, you know, what we term as market making. And probably what prompted a bit of this is where, you know, the term market making in this industry has come to mean something nefarious, and I might have thrown out a few emotional comments going, "Hey, listen, we're good guys, we're not hunting your stops." Okay.
So and that brings up our first topics for discussions is the myths and misconceptions, and I'm gonna be transparent here. I'm the first to admit I did not have a clear understanding. You know, I look at the chart and I see, you know, those ranges being set, those sell walls and those buy walls, and I'm like, oh, it's the market makers pinning us in this range. That's really not how it works. Market makers are not the ruthless whales that are coming after us all. You're not stop hunting us. What exactly does a market maker do?
I mean, it's a question of how you view the market. I mean, fundamentally, you can say the market is just a place where people are buying and selling. So it's a market made of buyers and sellers, and there's nothing wrong with that view. But you can also view it in terms of liquidity, and there are makers and takers. So, most people trading, in terms of the number of people trading, are taking liquidity from the market. So when you're clicking your buy order and your sell order, you're sucking liquidity off the market. And what market makers do is actually very simple. We're adding liquidity to the market. And that's what, and this is where this term, if anybody's familiar with which I guess everybody is, you'll see maker fees and taker fees. And the taker fees, or, the term taker, is actually based on the fact that you're taking liquidity, and makers and market makers are the people, some of the people who are adding liquidity to the market. And in simple terms, that's what a market maker is: somebody who is providing the market with liquidity. And by liquidity, I mean orders on the books. So
limit orders.
Limit orders, not always, but almost exclusively limit orders. Yeah. And the market makers can contribute unknowingly to moves, because we do, if we see volatility, we're adjusting our spread so we can create liquidity holes in the books, which almost by definition will cause rapid price movement. But market makers love low volatility markets. It's like, it's free money. It's an ATM. If the market is low volatility and in a defined range, I mean, we're just printing dollars,
But if the volatility is higher, isn't the spread wider and hence more profitable?
Yeah, I think that to understand, I mean, there are different types of market makers, and to be clear, there are bad actor market makers as well. And in this, if you consider somebody using their stack to push the price around, bad. I don't. I just think you take a risk with your own money. But again, I'll go back to my libertarian views on that. It's not pleasant when somebody forces the market. But in principle, what a market maker is doing is, and there are different types, but if you can kind of focus on the main one, you have a spread of buy and sell orders around the price that are moving with the price. I actually think, Keith, I sent you an image because when
I'm looking for it now.
It really perfect. So, a lot of people will look at this OB order book, and what you can see, because the order book when I took this shot is so thin, is you can see what market makers do. We're tracking the price with buys and sells, and most people use a method called Stoikov. Again, you can Google that, but it's actually quite simple, which is we're trying to retain an entry price that is glued to the live price. So we're DCAing. So when it's going up, we're selling, and when it's going down, we're buying. So we're always against the action. And once we get the position in the profit, into a profit, and the profits are tiny, we'll unload. So it's not market makers, real market making is price irrelevant. Yeah, I really don't care as a market maker, or my market making activities, if the price is going up or down. I care about the volatility, the spread. And what smart market makers do is they will vary the spread with volatility. So you'll have some measure of volatility, and and you will vary the spread on the buy or the sell side, so that you can retain a dollar cost average position and unload when you see a profit. And those profits can be minuscule. I mean, you're not looking for anything. You're also not trying to necessarily predict the price. So if I see a 0.1% net profit, I'm beginning to unload immediately. You don't want to carry inventory, if that makes any sense.
So so are you basically trying to snipe the spread?
Yeah. So I mean, the definition of spread, and I use it in two ways, which are completely different. So I will have a spread, what I call a profit spread. So which is what I'm expecting from average entry. So I'm constantly buying and selling based on how the price, and I'm always wrong.
Would one of these other slides speak to that, like your delta neutral slide, or the ones that you just sent me a few minutes ago?
No, I can just show you, but if you just look at kind of the main form of market making, which is the Stoikov method, is that you're always wrong, because your limit orders, the price has to go against your intention, if that makes sense.
Right.
Because you can't fill a limit order unless unless you're betting against price movement. So what you're doing is you're layering your orders, and you can clearly see it in the order book chart there. And when the price reverses, then you are unloading your position. So you're in this constant process of unloading long, short, and loading long, short. And what kills you as a market maker is if you don't factor in, what we used to call BARTs, which are these hugely volatile moves that will actually break your model, and you then either have to call a hedge, which we can discuss, or you start to offload in a loss. And because the margins are so tight, you can be making lots of money in this game, relatively lots of easy money, but one foul move can cost you the rest of it. So it's a game of zero price prediction. You're looking at how price moves, not where price moves, if that makes any sense to you.
Right. So you're just looking at literally the local, extremely local trend, right?
Yeah, and again, if you look at kind of higher frequency, and again, this is something, so you can consider them like, I guess, retrace machines. So if the price goes up 5%, you can have a reasonable mathematical model that says, well, if it goes up 5%, then it's always going to come down 1%. So I'll DCA 5% and unload the 1%, if that makes sense. But the smaller the time frame, the more opportunity to unload you have. So if you look at hourly candles or daily candles or weekly candles, this move from 9.3 up to 42, incredible move, looks like it's had very few retraces. But if you look at that in second candles, it's almost ideal market making conditions, because we get lots and lots of retraces. So again, we're fading the market, we're buying or selling against the market and unloading at every retrace. And what that does is provide liquidity. And that's what you see in the image there, is classic Stoichkov market making, which is basically just trying to glue your rolling entry to the price, unload when you can, and have no view of price direction, just how price moves, how far it's going to move in the time frame, and how far it's going to pull back. And then if it gets a move that's what I call an uncontested, it jams up 10%, and you can handle that move, what do you do? And what you do, and again, this is maybe one of the things that market makers, so I have little algos that if they sense volatility, okay, I'm just pulling my bids or asks depending on which side of the trade I am. That creates a liquidity vacuum, which adds to the BART, but we're not causing it.
Right. So the extreme volatility that we've had, in recent weeks, from about Christmas Eve on, it was just like ticking $1,000 a day, and then it's gone even beyond that. The market makers dampen that liquidity, that volatility rather, by providing liquidity. So when we see these huge moves like this, is it due to a lack of liquidity, or is somebody trying to push this book? Are whales pushing that book, or is it merely, they're taking advantage of the lack of liquidity in there, and market makers take a step back when volatility is that extreme?
Well, I think the only time in my experience that we've seen a lack of market making was the COVID crash. And if you look at the books after the COVID crash, you could see the market making activity. It's obvious. It's on the books. You can't hide it. Okay. And you look at the COVID crash, which took out some of the biggest market makers in the game. And then you can see them start to scale back in about a month later. So I don't think there's necessarily a lack of market maker liquidity. Market makers get stung the same as everybody else. But I do think that spreads are going to be a lot wider, which will dampen price movement less. So, when we've had an asset that's gone, in a year, my God, we were 3,500. We're now 42, or we were at 42. That's an impressive move. Okay, so I know certainly that the kind of algorithms I use will have tight spread, wider spreads and hence contribute in essence to greater volatility. But we're beginning to calm down. I can see my spreads calming down. But also automated market makers are looking at volatility in the second view rather than the minute or the day or the month view, because we're trading, you know, we're fading the market and selling off as fast as possible.
All right, that makes sense. Fred, have you got anything you want to add to this to this point?
I mean, it's definitely interesting to hear about the perspectives of an actual market maker. I mean, yes, you guys provide liquidity and therefore dampen volatility. And I've also been seeing in the books that you're not always present. So there's, you know, certain conditions that trigger your presence, and I'm really interested to learn more about that. So when do you usually get aggressive with placing, you know, orders in the book, and when do you pull them?
Okay, so I can speak for myself, and obviously everybody who's involved in market making, and I need to point out, not everybody who's involved in market making is in, you know, a big market making company. I know people who are making the market with $1,000. God bless them, fair play to them. But from my own point of view, I measure instantaneous volatility just looking at buy sell delta. So if, for example, I see buy sell delta, you know, actual orders, market orders, okay, I'm pulling or spreading out my orders instantaneously. Longer term market makers, and there was a very famous case that after the COVID crash, if you look at the BitMEX order book, you could see that the market maker spread was enormous. Okay, so you could see that these bands had widened out to kind of thousands of dollars over, you know, a $7,000-8,000 range, and this, and I do think a lot of this contributes to Bart's, in that a lot of people will look at instantaneous volatility and pull liquidity from the market, and then a whale jams it, and we'll guess the news. If there's no liquidity on the market, that price is going to jam. Mm-hmm. But I don't think it's with intent. I mean, you guys know better than other people are putting up fake walls and this, that, and the other. I don't view that as market maker activity. I view that as whale activity.
Right. So can you walk us through, like, you know, a typical move for you?
Yeah, I mean, I sent you earlier on. I was just pulling some data for the last week from this one I have in test. Keith, I don't know, it was a spreadsheety one, the dollar cost average one. Let me just
is it the one you sent me today?
No, you're asking days, or let me have a look at. I think it was the first kind of Excel spreadsheet I sent you. Yeah, the first one I sent you the other day.
I didn't get an Excel.
No, I would have screenshotted screen. It's a print of an Excel sheet.
All right.
So
a second.
That was the one.
Oh, that was it?
Yeah.
Okay.
So again, here is a classic example. So this is just the orange color there is obviously XBT price. And you can see we've covered a reasonably large range there on the left-hand axis. You can see, let me just bring this up on my own screen so I can see it properly. You can see that we've kind of done maybe 30% or something move. And the blue is the actual average entry of one of my market making algos. Yeah. So what you want to see here as a market maker is you want to see that absolutely stuck to price. So wherever there's a variation here, you are carrying exposure of inventory. So for example, if you look kind of, you know, a third of the way from the left across, you'll see that the dollar cost average price or my average entry is varying quite heavily from price. That means I'm overburdened, in this case short, because the price is going up. And again, so what you see here is the ability to, and you'll also see that the steps in the dollar cost average change. And this is because my algos are sensing volatility So I'm widening out where I'm prepared to add to a position, and therefore you see the dollar cost average become a lot more like a staircase instead of when you see the prices more ranging, that basically I'm just churning. The gray or the dots are just the difference between average entry and the price. And this is the key metric for a market maker. You want that to stay within reasonable limits.
Okay, so just so I understand, your blue is your average, is your DCA price, right?
Yeah.
And so when you say you're separated, there's some deviation between your average entry and the price, but your average entry appears to be in those positions well below price. So does that not make this a more profitable trade for you?
No, because again, if you think like a market maker, as that price is rising, I am going to be net short, because you're always trading against it. So I have to wait, and you can see that the dollar cost average, I have to wait for a retrace, and you can actually see it there. So after the kind of the first big steps, you can see that I've offloaded my position and then added in at that. So what with the secret of the game is to develop a range that you are prepared to dollar cost average over, and to try and glue your entry price to the live price and just snip profit as soon as it's available. So in none of this is there any price predictive analysis. So if it's going up or down, doesn't matter. It's how it's going up and down, and buying and selling to glue your average entry to price and retaining as low an inventory as possible.
Okay, and when you're doing this, since you're taking very, very small percentage profits,
yeah,
this has to be a high volume game.
Yeah, it's there's a couple of things that again people don't think about, and one of them is again maker taker fees. So if you're trading on Binance, and I don't want to specifically mention exchange, but I've said it. So Binance, and you're clicking buy or sell, or even if you're doing limit orders, you're paying fees to the exchange. As a market maker, that's not great. So if you're on a couple of the exchanges like, Bybit, MEX, where I trade, I get paid. And this is not because I'm a market maker. We all get paid for filling limit orders. And that is a huge thing. So, and you add into that leverage. So if I can put it to you like this, if you're trading $100, you've got $100, okay, and you're prepared to go 2 or 3x leverage. Okay, so let's say 5x, keep the math simple. So every trade is $500. Okay, I'm getting paid by MEX 0.025% for that $500 entry, 0.025% for that $500 exit. How often can I shove that backwards and forwards defines a large part of profitability. Churn, speed, and that's such a huge factor if you're looking at market making. So if you're doing, if you're paying maker fees, then you have to factor that into the spread or the profit that you're taking. Whereas some exchanges, and again, MEX being the most notable, and Bybit, I don't trade in Bybit, where you're getting paid when your limit orders are filled.
Right.
And I think that's a really key point. And some exchanges will offer you discounts and so on, but your objective is just churn, and it's not wash trading. Wash trading is a very different thing. It's literally just you have a spread, you bids and asks, and what you want as a market maker is to keep your inventory really low, i.e. your contract size is really low, and just push them backwards and forwards across the line and keep paying me those fees, keep paying me those fees. So in my case, the way I mean, 40% of my profit will be trading fees. And that's,
wow.
Yeah, and which really just defines how little profit I want to make on the actual trade. So I'm a lot happier, trading, 10.1% trades than I am trading 10% trade, because the frequency of my 0.1% trades will be far higher than the frequency of my 1% trades.
That makes a lot of sense. You are really in inventory management, aren't you?
Because I started this and didn't realize I was making the market. Yeah. Okay, so like everybody, I went through 2018, 2017 and Mount Gox and all this stuff. And I just thought, fucking excuse my language, market makers are here trying to steal all my bloody Bitcoin. And then I started this primarily on the basis that I looked at my prime thing when I look at trading is I look at contracts and edges. And I thought, hang on, if BitMEX are prepared to pay me money just to have an order filled, there's got to be an edge. So I kind of built this stuff and then looked back and realized I was market making. Okay, if you see what I mean, rather with the objective to go out and be a market maker. I kind of reversed into it and I was actually in an interview with Sam Bankfield-Fried that was very influential to me because he has the same issue where he looked at it and he said, look, this term market makers is so misunderstood. They're not hunting your stops. I love, there's nothing better for a market maker than a ranging market. Yeah, you give me something where I can say this thing is only going to move 0.5% a day for the next 6 months, and I'm on Lambo.com.
Right.
Or tested, to be fair. Okay.
I'm currently on usedkia.com.
Or as it stands for in this country, fix it again tomorrow.
Right. Hey, a quick shout out. Michael is joining us from France, sipping on a glass of wine here on a Friday night, as he's known to do. He's also a great contributor in the community. We appreciate you, Michael, and everybody who's joining us here now. What else can we dive into? What about the tools that you use and the strategies that market makers use? There's 3 primary ones. I'm sure there's more, but some that I've read about: delta neutral, HFTs, and grid trading.
Yeah,
what's the difference?
I have some questions regarding that later on. But go ahead.
Yeah, and again, understanding that I kind of found myself being a market maker unknowingly, but there are different ways of making the market. And again, what I'm doing is really a combination of what passes for high frequency trading and grid trading. Okay. Delta neutral I do as well. So in delta neutral, the basic concept is that you look for exchanges with different liquidity. So you look for an exchange with high liquidity and an exchange with low liquidity that are trading the same asset. And what you simply do here is that you would limit order on the low liquidity. Okay, so you'll have a spread, and as soon as that fills, you'll mark it out on high liquidity, and in that way, on average, you will earn a nice small spread. The issue with and that would be kind of classic legacy markets. And you can do it in this because we have exchanges that are ridiculously low liquidity and high liquidity, and it's some form of arbitration as well. However, you can also do this intra-contract. So if you look at any of the exchanges, typically they're offering a perp contract, which would tend to be the highest liquidity, and they'll be offering a futures contract, which will almost certainly have lower liquidity. So you can limit on, and you're not DCAing here, you're literally just popping orders. So you can say limit buy on the futures and immediately market exit on the perp, and in that way you get a spread simply because of the liquidity differences, in that the lower liquidity is going to effectively move that little bit that you need faster than the higher liquidity, simply because the liquidity will slow it down. You have to independently fund these. You wind up positions in inventory, and then you basically have to reverse it and de-wind it. So you're long one contract, short the other.
Mm-hmm.
Yeah, high frequency trading is, and again, this is a term that, anybody who's watched any of these kind of movies or knows anything about traditional markets where, they're installing microwaves and so on, it just doesn't work in this game because, we were having a chat earlier today, guys, and I'm going, look, my definition of high frequency is when I see a tick on the exchange, I want to have my order on the books within 2 seconds. So just to put in some time context of what high frequency trading means to me. And again, when you look at this, and again, if you look at the previous discussion, so, if you're trying to load and unload contracts effectively on the noise of the signal, the higher the frequency that you can trade, and particularly when you're getting paid maker fees, the more you can churn, the more profit you can make. And grid trading is really just adding in this idea of averaging in your price. So what I do is high frequency simply so that I can catch every little retrace feasible within the time frame I can trade. And grid trading is really just about, again, defining a range of price movement over which I'm going to attempt to keep my average entry glued to price. And beyond that, I have to make a decision. So if I move beyond that range, I'm going to call a hedge, or I'm going to take a loss.
Is there a typical time or a scenario where you gravitate towards one strategy versus another? Like, grid trading, for example, does that perform best for you when the market is a little bit choppy or sideways versus a very volatile trending market?
I mean, delta neutral works really well when the price is volatile in small, in very small time frames, where you see, and if anybody ever overlays, and again, I'm mentioning BitMEX because it's primarily where I trade, just overlay the price chart of the perp contract to one of the futures contracts, and you can really see this thing, in micro detail. So we're just looking for a difference to jump on. Yeah. The grid trading is my primary thing. And if you're going to get into this, this is, again, a lot of people look at market making as a software project, and it's not. It's a mathematics project that can potentially need software, because you can market make manually. Yeah. And what you're looking to do, let me put it to you like this. If you knew that Bitcoin was never going to move 10% in one direction without a 1% retrace, you know how to trade it. Yeah.
Right.
I mean, that's easy. Yeah. And so what market makers do is they do kind of very detailed analysis of price history and run different spreads and DCA strategies across that to find optimum spreads for different market conditions. So, for example, when I backtest, I have to backtest against every price tick. So I'm not downloading 1 minute candles because they're of no value to me, because in that 1 minute, I potentially can make 30 trades.
Right.
Excuse me. So what you're really looking at is, and this is why I'm no doubt that within 3 months, you guys and Fred and so on will all be market making and loving it, because it's mathematics too. Yeah, it's not technical analysis. Yeah, this is literally just show me. If and then obviously you can define a spread that covers every possible price movement. I can go 0, 100% plus, but I'm never going to make any money because I'm just going to be pushing small bits around. What you then do is you say, I take my back tests and I go, how frequently do I get in trouble? Yeah. Mm-hmm. And then I have to balance the cost of getting in trouble versus the intermittent profit in between, if that makes sense. So for example, if I need to pull a stop once a day, but I make so much more money because my spread is so tighter over time, then that's the optimum solution, rather than this idea there's this kind of Uber spread that will cover every single Bitcoin price move. There is, it's called plus minus 100%, but you ain't going to make any money. Although plus 100%, it wouldn't be do you any good in this market, but you know what I mean. You can define an infinite spread and you might make a buck. So what you try to do is you try to have a model to say, look, in general, I'm going to run into trouble with a frequency of every 16 hours or 20 days or whatever it is. But by having a tighter spread or less of a zone to trade, I'm going to print more profit that compensates for that. So you've got kind of competing curves. And then the real trick is hedge. So the real trick, as in all trading, we all call it wrong, and trust me, I'm a legendary caller. I've been calling $1,315 as a Bitcoin price for years. Okay. Okay. But when you're wrong, okay, the question is, what are the consequences? And that's where kind of risk management, and particularly hedging, and particularly in this game, and particularly there are so many new tools, i.e. contracts, because as a market maker, you're just betting on a range of volatility. And FTX and these guys have introduced some really cool ways to hedge volatility.
All right, we're going to take a deeper dive into hedging and risk management here in a minute, but
I'm going to have a smoke just to show you I do take risk.
Oh man, Ab is watching, and thanks for watching, Ab. She asked, and we're touching on earlier about you can market make manually versus with automation and algos, and obviously the game has evolved drastically in the last several years. But Ab asked, is there a difference between market making on, say, CME futures and crypto exchanges?
In principle, no. I mean, market makers exist in every single market on the planet, pretty much. And it used to be, as an example, that when, and I don't know, this could still be true, but back in the dim distance days of 2017 and 2018, when a coin wanted to get listed on an exchange, they actually had to bring a market maker with them. The exchange doesn't want something on the books that doesn't have liquidity, doesn't actually have it. So market makers, are an essential part to making a market. Okay, so that applies to all markets. I don't do CME. Again, I'm very, very focused on and a lot of that is direct exchange access. So there are different barriers to entry. Okay, anybody listening to this who has $10 or $20 or $100 can, or more, obviously, has direct exchange access. When you look at traditional markets, you need to be pretty well stacked, and even then you need to go through a process to have direct exchange access, and that counts because that defines the fees you pay and the frequency you can trade at and so on. So I don't really look at market making on legacy exchanges. It's of no particular interest to me, and the challenges are different because, again, this concept that luckily in Bitcoin and crypto, we all have direct exchange access, and it's inordinately rare in traditional markets.
And you made the really amazing point that if you find exchanges, and they've been found. So if you choose to do this, you have got to find yourself in a position that you're trading on an exchange that's going to pay you a commission for market making. Because
you don't have to, but why wouldn't you? They're there.
Right. Well, you're going to
I'm going to walk past that tenor in the street or pick it up. Well, pick it up,
Right. You offset a ton of risk, and you really minimize what you need to target in profits. And obviously, tiny profits are much easier and much more consistent and reliable to grab than waiting on that, 5%, 10% move. Yeah,
it's a game of simply hoovering up pennies.
So let me ask you this: in the volatility that we've had, in the past couple of weeks, running up to 43,000, did you just, sit there and make your HFTs and micro trade it all the way up, or do you, set something aside and have some fun with a swing trade?
Okay, so again, in terms of my net position, I guess, I mean, my market makers are my bread and butter, but I'm net long. Again, I've been in the game long enough where it makes sense. I think my dollar cost average, not to is about $700, but that's based on cost of mining. No, but that's based on cost of mining, not that I actually went out and bought any of this stuff. Because again, I've never heard of trading to me is something that geniuses did, and I only got into trading because of this market. So I'm always spot long. I would recommend that to anybody, and I only ever short Bitcoin because of that. Because if I measure my return in fiat, okay, I go, this thing running up to 43K, 100K, a million, and obviously not financial advice, but that's what I'm betting on. Okay. I'm more interested from my net position in covering down moves.
Right.
Now, I do, because I used to do this. I used to be, a candle chaser, a crazy scalper kid. Okay. So I do every so often go off and say, but it's for fun. I'm going to sit here and just try and scalp the crap out of this thing. Excuse my language. Scalp the crap out of this thing. And, that teaches me humility.
Yeah.
Yeah. And the market's very good.
And it ages you.
Dude, I'm only 22.
I was going to say, you look pretty good for 23. Michael asked, and we touched on this a little while ago. He's like, I'm a bit late, so I've been rewatching earlier at 1.5x speed. So he appreciated the smoke break so he could catch up a little bit. He mentions that latency seems to be really important for pulling this off successfully. Can you speak more about how you address that?
Yeah, I mean, you can put your servers next to the exchange servers, because all of these central exchange servers are typically in AWS. Yeah, so where I run my algos would be pretty much which bizarrely enough is in Dublin, which is where I live, and there's no particular reason that I live here because Mex have got their servers here. It's just a strange coincidence because Amazon have a farm here. You can do that, but most of the API issues are to do not necessarily with any inherent latency. It's just to do with too many people and you guys see this all the time, and people get frustrated over, and I don't really think they understand the complexity and I'm not giving a free pass here to the exchanges, but the volume of order processing the exchanges have to do, and that's where you get kicked out. And other than maker fees, I did try to move, and I have done some market making on Bybit, but the reality of it is I couldn't get their API to work in any way a good enough form for the kind of frequency that I wanted to trade. So again, you can do this manually. There's nothing here that requires algorithms to do this. It's just faster, and again, speed is a good thing. And
you're not as fast as you used to be when you were 22,
dude.
Last year.
Yeah. I find it difficult walking down the stairs in this place. But yeah, I mean, and the other great thing about algos is, they don't do that emotion. They do what you tell them to do once you've shaken the bugs out of them, and that's not a bad thing. So yeah, APIs are always going to be an issue in this space. I have found MEX. And again, I don't own shares in MEX and fucking hate them. They cause me grief. Okay, but it's still the place I trade
because it's profitable. Yeah,
it's profitable, and so on. And I am looking at moving. I mean, again, one of the risks to me is the one exchange risk. So I'm constantly looking at other exchanges and other contracts to do this on, because if MEX closes down, then that's not good for me, and that again is one of these systemic risks that everybody here faces. We don't like to think about, but Quadriga, Cryptopia, Mount Gox. How many of these do we have to see before we go, there's actually a genuine risk of this happening?
See this right here? Those are tread marks from the Cryptopia bus.
Dude, and I know in the form I come across as a no shit coiner, and I kind of am. But Cryptopia, man, I had so much coin on that bloody thing. But
we had a client. Brad and I had a client that was on that exchange, and that's where they were paying us. And I can't go any further. It hurts.
The market is, if you ever get too kind of cocky or confident in this market, we will always teach you humility.
Uh-huh.
Yeah, I think I'm on about a 6-day cycle on that.
Pretty damn good, man. Pretty damn good.
So
you're going to have to write me a note about how you're that good.
You mentioned, on the latency issue is, basically parking your servers on the same service that the exchanges are. How do you go about discovering where they are? Is that
Google?
Easily published?
Yeah. I mean, just trace their IP address.
Yeah.
Google it. I mean, it's not it's not too much of a mystery. But again, I don't. That's kind of, it sounds cool, and people go, I've had this from people and go, oh, you're in Dublin because of this. And I go, no, I'm in Dublin because I live here. Right. And it wouldn't matter if these things were in Singapore, I'd still park my server next to it. On principle,
It's pretty obvious why you're in Dublin. I thought about it in the beginning of this when we introduced you, that we could say, from his home in Argentina, but you could tell by the accent, or he's in China and with great machine learning and AI, he has disguised his face and his accent. Let's dive into that important topic, and one that, whether you are a market maker or just a trader, and especially if you're new, you have got to learn, and that is risk management and capital preservation. So, again, we talked about these. You touched on this before. You're really playing these really tight ranges, eking out tiny profits. How do you identify your risk reward ratio on a profit margin that's that low?
Well, I mean, fundamentally backtest. So I will, and again, I don't think this is unique in any way, unique for people who do market making. You're betting on a volatility range. That range is variable, and I have to say that if you are going to get into this game, having a fixed range, burn your money. At least you'll get heat from it. Okay, but you have a variable range, and you will. And again, it's more looking at this. You're looking at frequency of being in trouble versus profit. Okay, so the smaller the range that you're going to play, obviously, the more frequently you're going to be in profit. Oh, sorry, you're going to be in trouble. But it may very well be that you make more profit than you lose in those events. So there is this kind of balance between taking no risk at all, okay, and making no profit, and taking too much risk and losing it all. And the way certainly that I would deal that is, I will take these kind of mathematical solutions to price movement, and I'll run them past every price tick in the history of Bitcoin.
All right. So clearly not just a simple traditional ratio on risk reward on a 0.1% profit.
No, again, I'm sure that there are people far more mathematically adept than me that can look at this. I develop mine because I'm just a bloody engineer. I'll run 15, 20 back tests side by side, and I'll look at these things, if you see what I mean. And then, again, but the other side of that coin, which you are always going to end up in trouble. Now, what you define trouble is you're massively underwater and you have to sit and wait or hope the price comes back to you, or you're taking a defined loss, or you're hedging. So a lot of my focus would be, well, let's look at how do we hedge. When you're wrong, whether you're algo trading or manual trading, how do you manage the cost of being wrong? Because you're going to be wrong enough times to think about that.
Okay. We had a question from, let's see, where does this, what do we have? Thing Builder says, what's the advantage? And thanks for watching and listening, Thing Builder. He's watching on Periscope. What's the advantage to hedge versus simply closing the trade and taking the loss?
Yeah, because in an ideal hedge, you will either be looking to make a net profit or cover, or at least net break even.
There you go.
So and again, that very easy to say, obviously. Yes. So, well, I mean, this is when I'm in a loss, I have a hedge that covers my loss, maybe even makes me some money. Not necessarily so easy to achieve. But there are certainly techniques and contracts out there that can, at worst case, reduce your net loss. And again, I think this is maybe a mistake that a lot of newbies make, and I can say that for a fact because I've made it, which is I might have multiple positions and I might have, net profit on all of them, but I don't want to close the one in a loss. I have this psychological thing going. I can't take a loss, even though I've constructed it. So that's a great thing again about algos. It doesn't. It just goes, look, if I need to, if I'm holding, because I will typically be holding, say, 3 positions, 2 as a hedge and 1 as a market maker. If overall profit is tending to unrealized profit is tending to 0, it'll just automatically close everything down and start again.
Fred, have you got anything you want to ask or comment on about risk management?
Yes, regarding the hedging, what are you using to hedge? Are you using
so many different things,
futures or options? What are you using?
Yeah, I mean, I have used, and this is a constant battle. Okay, so I'm constantly, and I'm something I will be begging for advice on. So I've used move contracts, which are effectively an option straddle. Mm-hmm. I would hold longer term BVOL volatility tokens, which at a different time cycle work. And then about 7 months ago, I started to run 2 algos that I call top hunter and bottom hunter. Don't ask me, just crazy, okay? And so what I do now actively on most of my algos is I will have a long position and a short position with the spread. So let's say I'm long 10,000, short 15,000, okay? I take the risk once of constructing that position. I now have unrealized profit of spot, say 30, 50% or whatever, say 30%, okay? I will use that unrealized profit as a hedge to a live algo, and I'll analyze net position. So I've taken the risk once, which is they're algos anyway, and they're relatively low risk in terms of creating this spread between a long position and a short position. I don't close them, okay? I try to widen them out. And I use that unrealized profit, which is the only risk I've taken in constructing them, as a way of leveraging that risk multiple times, if that makes sense. Mm-hmm. And that's what I would do on a practical basis. But there's so many cool contracts. I mean, they're, again, and I'm no fan of FTX, but FTX have some excellent volatility contracts, and the BVOL and the IBVOL over longer term, and move. Move is a dangerous contract to play, but again, if you're automating it, you can use it as a hedge against a market maker, because again, move is paying volatility and market making is betting volatility, if that makes sense.
It does.
So as a market maker, you're betting against volatility, right? You provide.
I'm betting on a defined range of volatility. So yeah. I'm prepared to grid trade or DCA this thing through a range of volatility. So I have a bet on a specific range effectively. But move allows me to take profit on volatility moves that would hurt that side of it. Mm-hmm. Or BVOL or so on. So, and again, this is the balance of trying to have perfect spread and never letting your market making algos or whatever you're doing run into trouble and making no money, versus balancing that with, well, it's going to do this every so often, and therefore I'm going to pull this hedge. But the long short thing, don't discount, particularly as a manual trader, because it's quite a simple thing to trap profit and leverage that profit as your continually, repeatedly as your risk. Mm-hmm. Right. So for example, what I would say to manual traders is, you're long Bitcoin from, 30,000 to 40,000, and obviously you're kind of going, fantastic. Well, instead of closing it, why not just short 40,000? Mm-hmm. You're trapped. That profit, if Bitcoin goes to 100,000, it also gives you trading options. Am I making sense there? So if you've got, if you're long 20,000, short 30,000, Your profit is the same if Bitcoin is at 100,000 or a buck. It's like closing, but it's trapping that profit. And what I do is I use that trap profit, which is effectively a reflection of the risk that I took, and I use it again and again and again and again.
You're recycling that position, basically.
So
you're
from
recycling
then
the
on,
range.
yeah. So from then on, the rewards for that risk, I'm using as a hedge against other risks. I don't know if I'm expressing that correctly.
I mean, if you close the position at, we peaked at what, 43 last week, right? If you close a position at 43 rather than short from 43, if you close a position at 43 and you buy back at 35, aren't you achieving the same net effect? Essentially,
you are, except you're re-entering risk.
Right.
I think we'll have to.
Do you see what I mean? I mean, if I don't close, okay, but what I can do then is adjust the position or open a third trade. Okay, and that's the way. And again, I know it's kind of a strange way to think about it, but what rather than close, just open an equal and opposite position.
And that, I've been rather than traditionally DCA, I have in the past few months just been laddering the positions, and I can DCA them if I need to, but this way I can scalp, and I'm a scalper, right? So I can scalp the tops without losing my better entry, and what so I'm basically closing the top of my ladder rung by rung on the way down.
Yeah, it's about options. I mean, unless you need the money, why close the position? Just close it off with an opposite trade, and now you have options. Yeah, right. You can have a third trade, a fourth trade, and so on. And obviously, at some point, you have to close this stuff. But one of the things, because if it goes higher, you might DCA your short. There's loads of, and again, it's just kind of something that I think that when people who are directional traders, which is most people, and there's nothing wrong with that, is maybe just look at building multiple positions, because having options in this game, as everybody knows, and I don't mean option trades, always good to have some options as well, but leaving yourself lots of out and lots of flexibility is never bad, because we might all have confidence that our move is going to play out, but again, the market will teach us humility. I like having lots of positions open
and managing your capital and preserving, so that you can exercise those options when they present themselves, because sometimes things just present themselves, themselves that you weren't expecting, and you want to be able to take advantage of those.
If you're getting liquidated, and I'm sorry I'm going to use this language, you're a fucking idiot. Okay, so excuse me. Okay, because A, it's cost you 15% for the privilege of it. Okay, and B, I don't understand the rationale. Go to the casino. So whether your risk management is limiting your downside, or you're playing kind of different games and so on, giving money to the exchange by getting liquidated, I don't understand. I think it's. I was listening. I think I was saying to you guys earlier, I listened to a blog or some kind of thing last night from this kind of old world trader, and he said, look, trading is like catching buses. There's always a new opportunity, a new bus coming along, but if you're under the wheels of the last one, you can't catch the next one. So yeah, man, and again, I don't want to give the impression that I haven't been run over by that bus, man. I've been run over by fleets of buses. Okay.
There's another bullet point we had on a risk management slide, and this is something that I haven't heard a lot of people talk about, but it's something that you firmly believe in, and that is insurance. Explain what you mean and how you apply it.
Okay, so when I say insurance, I mean, risk management we all think of, and we should all think of in terms of trading risk and so on, but there are systemic risks here. And again, you only have to be involved in craptopia to realize that. So I would encourage everybody, I don't care if you're trading 10 bucks or 100 bucks, is that you take a percentage of your profits and you put it into your own insurance fund. That's on a ledger, that's off exchange. Because again, I'm a believer. I think this thing is going somewhere. and that there are systemic risks. So it to me, and again, I say this to anybody I kind of work with, is like, you have to have an insurance fund. You have to start about thinking about building it, because we can all get comfortable trading on BitMEX or Binance and all this stuff, and you know, the same way we were all comfortable on Mt. Gox and Cryptopia and Quadriga and all the other ones, and then guess the news. That's a systemic risk, and it's real, and so on. So again, I would encourage anybody in looking at risk is, and again, I'm not saying this to frighten people. You need to take risks, and you should be encouraged to take risks and smart risks, but you should also understand what the risks are and have a plan in the event that the risks realize themselves. And exchanges going under and running with coins is a real risk, so insure yourself against that.
And avoid the ones that you know to be shady, and some of those have been pretty obvious in your.
Dude, I'm unaware of any cryptocurrency exchange that isn't shady. You know, it's just levels. Yeah.
Levels of shade. That's right. How big is the awning? Right. Oh my. So just a couple more questions I wanted to touch on. We've chewed up I don't want to chew up your whole day. I know you have you have charts to study and trades to make and cigarettes to smoke.
An interesting market action to watch.
and very interesting market action to watch. So one of the misconceptions that I had was that it really takes a significant amount of capital to be a market maker, but you've shared with us that it really doesn't. How much, if somebody wanted to do this, how much do they, should they expect to really need to be able to do it effectively to get started?
Okay, so if you look, so it's quite simple. So in many ways, you go, look, let's say that you decide that you want to have the ability to DCA price movement with 10 orders, yeah? Mm-hmm. Okay, and let's say that for the sake of argument, you're adding 50%, so you can calculate how much you need. The gotcha in it is that some of the exchanges have spam limits, i.e. that, for example, on MEX, you cannot continuously place limit orders that are less than 0.01 Bitcoin, which in the current market is what, $350 or something. But some exchanges don't. So if you want to hoover up the liquidity or the maker fees, then you need a bit more. But you can do this and again, in traditional markets and even on this, and I run Market Jam, as in where I'm marketing order, which is almost something against my religion. I just believe that exchanges should pay me for my orders. But you can have a very small amount, as long as, again, you have a model, so that I start with an order of $1, my next order is 2, and then 4, and then 6, then 8, and you can look at that. You don't need to either risk huge capital or have huge capital to be able to do this. Having a decent amount of capital will open up the gates of getting paid for your orders, as in, again, the spam limits. So most of the exchanges that offer maker fees will block you if you're continually placing orders beneath the spam limit.
Right. That makes sense. And
no, you don't need an awful lot of money. And again, I wouldn't encourage anybody to risk a lot of money until they know that it's working for them.
Right, like we said earlier, scale your way into this, or anything that you're doing in the trading realm. Scale your way in. Start small, master something. You don't have to be the master of everything, but master something, starting with risk management, and then start to scale what you do.
And again, just bitter experience. So again, I'm I don't want to come across as somebody who's beating the market. The market has beaten me many times. Okay, but what I do know is it's better to risk $100 losing the game, okay, than 10,000 or 100,000.
Right.
Until you can consistently outperform the market. Learn the craft, learn the trade, and again, as we were discussing earlier, this is an unusual game because, unlike any other game, okay, you go straight into the Premier League, you go straight into the top. There's intermediate traders markets that you can do. You're going from zero to hero immediately.
And there really are only two columns, right? Winner and loser. Winner and loser.
I mean, that's the beauty of it. It's a fairly digital activity. You're either winning over time or losing over time.
So in terms of expertise to do this, do you need to be, do you think it's more important to be truly a market expert, following the market, knowing what's happening, knowing what different assets are doing, or to really just be a master and a mathematician and a master of what is happening on the range of whatever asset you're trading that is in front of you right now, regardless of all the fundamentals and technical analysis that may be happening around it?
Yeah, I mean, if you're doing the kind of market making I'm doing, you need two things. You need the mathematical ability, and you need to actually understand the contracts you're trading, which I think every trader should, by the way. But you need to, if you're going to market make a contract, it's not a bad bloody idea to understand the details of the contract. In fact, if you can trade it, and then last and least are some software skills. And if you don't have them, work with somebody who has them. I mean, I see this all the time where software engineers get into market making without the mathematical, not that they don't have the mathematical skills, they just see it as a software project, and mathematicians get into it and tends to be more successful.
Right.
Because this is not a software game. And again, basics, just understand the contract. I mean, I cannot, and I'm saying this from the point of view of not being critical, but saying to people, how can you throw around tens and hundreds of thousands of dollars and not know what the rules of the game are? Like, my God, please, for your sake, not mine. I have to take somebody's money.
And so are you using, for the most part, tools and algos that you've written yourself, or are you using, are there some, commercially available tools that people should be looking at?
I started using third-party tools, Haspot and so on, but kind of I ended up taking, because this is the great thing about this game. We're all, everybody is sharing, and I think that's really cool, but they're also sharing software. So, if you go to GitHub, you'll find sample market makers. And I, for me to sit down and write an API interface on my own, I'd still be here. But guess the news, I can pull in Python, which I can just barely manage to hack together. Okay. And I can get something running. And again, I think speed is really important in this game. So everything I do is command line. There's no GUIs. It's literally just, pop, 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 do the calculation, place the orders. So there's an awful lot of code base out there. And if you don't know that, team up with a coder. That would be my honest recommendation. If you have the math skills, okay, well, why not, team up with a coder and have a crack at this stuff? It's not, there's plenty of room in it, but one without the other doesn't work.
I know a guy.
Not me, by the way. Jesus, my God, is terrible.
Fred, I know you've got some questions. Why don't you take a crack at them?
So I have a couple of questions. The first one, how much exposure do you typically have to the market? Are you ever running out of capital when trying to DCA?
Okay, I sent just maybe to the answer is, of course, yes. I mean, you cannot. This is kind of almost Martingale-esque. I sent some images just to Keith there. The last couple of images I sent to there, Keith, which will quantify. There we go. Okay, so this is how I would measure risk. Okay, in a practical term. So this is the last week or something on this kind of spread I've been testing, and okay, the orange is price again, but the blue on the left-hand axis is leverage. So you can clearly see that the up move of the last day or so has brought me to the maximum leverage that I'm prepared to commit to this. Okay. So let's say that the price kept going and we jammed up to 52K. I would have pulled a hedge and taken a loss on this.
I see.
So again, this is now I could equally have a wider range. Yeah? I could cover a wider range, but I would make less profit net. So, at some point, the nature of the price movement is going to, get your algo stuck. But again, this is where you need to look at, again, it's basic risk management. When, not if, it's a when this moves against me, what are my outs?
Mm-hmm.
Right.
My outs on this would have been a move contract or some volatility tokens that I would have been DCAing and continue to DCA constantly. So again, it's this concept of looking at things net rather than, geez, I have to make money off this trade all the time. I don't look at it that way. I go, I have a combination of positions here, and what's important to me is if that one's in the red and I think it's going to, it's going against me, well, I'm net green or net zero, so I just close both of them and start again.
Okay, that makes sense. Another question I was wondering about was, how long do you usually have your orders in the book? Like, is it days in advance? Do you pick your levels days in advance, or is it really, on a very short time scale?
My orders are constantly capable of every 2 seconds adjusting, but pretty much every price tick.
Okay.
I'm adjusting orders. And again, not to shill BitMEX, but if you get into this, you'll realize that working on an exchange that doesn't have an order amend function is going to drive you crazy.
Mm-hmm.
Okay. So, I'm constantly amending orders. Yeah.
All right. So
I think that's a pain point for every trader, in a volatile market, is amending orders.
Yeah, and again, when I look at and particularly Bybit, and this is where and again, I'm not anti-Bybit and I'm not pro-BitMEX. I just look at it from what I have to do. I have to cancel the order, add it in again. And I'm doing this on lots of orders, man. Okay. And then you have rate limits and blah, blah, blah. So I'm always reverting back to MEX because it's just designed for idiots like me who do this.
Yeah, I'm managing trades through 3 which is, a pretty intuitive platform. It's pretty powerful and one that I've enjoyed, but it is a cumbersome task when you suddenly, go back and see that, the range is shifted and you want to adjust your your ladders. It's a pain in the ass.
And in a way, what you're doing there, by the way, is market making as well. I need
to get paid for this.
We're doing that. That's really what a market maker does. Yeah.
I need to get paid.
Trade a different exchange, man.
We're working on it.
Yeah.
We're working on it. All right, Fred. What else you got?
So the other question I had was, how do you pick your DCA levels? Is it just based on price action and spread, or are you also looking at the order book?
I don't look at the order book, and it's something that, and props to you guys, because I've been trying to figure this. Is there some kind of order book? I look at near-term volatility in terms of adjusting spread, but the spread that I currently use are just based on historical analysis. Now the spread isn't fixed. I don't want to give that, so I can judge volatility from my position, believe it or believe it not. And I know that because, remember, I'm fading the market. Okay, so the number of contracts or the amount of inventory that I hold will be a factor that I will be included in a bit of maths that calculates the next level. Okay, but what I currently do, and it's not optimal, is I just look at net buy sell volume in a 2-second slice. And I go, hang on a minute, maybe I want to widen this. Now that is not optimal, and order book analytics is something that I am definitely interested in looking at. I have another couple of project thingies that I'm trying to finish in terms of market making, which is a USD market maker. Where I trade Bitcoin to Bitcoin, but there's a bit of me at this price that thinks I might start to do a USD market maker. But it's these things like learning to trade. There's never a point that you stop market making, there's never a point where you can't do it a better way. There's lots of ways you can do it worse.
Lots of ways to do it worse. I've been exploring a lot of those. I'm finding the sweet spot by process of elimination.
I don't want anybody, and again, I'm going to say this again, to, if you see me calling a price in Telegram, I mean, just counter trade me. It's an almost guarantee.
So Michael's asking about amending orders because he's a guy who likes to program things and make them easy. He's asking, is that an API, a function of the API, or if it's programmatic, is it that really big a deal to address?
It's so again, I like to run as fast as possible. Okay, so if you look at it in a real simple way, okay, I can amend via the API an order on MEX, and it's one command. Yeah,
right.
Okay. And I do this
one command for your whole grid.
One command per. Well, I can do bulk command, so you have bulk order handling and so on. But if you just take the example of whether it's a bulk order or not, and if I don't do that, I have to cancel and re-enter, and then I've got the latency of the price versus hitting the. So by which I mean, take a simple example. Okay, I have to cancel a limit order. That's one command, and replace it. But let's say that the price is ticking really fast, okay, and that the new limit order is not allowed by the price. So I'm either market filling it, which I don't want, or rejecting it. If I'm order amending it, it means my old order still stands and I'm using less of my rate limit. So all of these things have a rate limit, how many times you can pull or push data to the API. And again, when you're trying to operate in these timeframes, you try to optimize that. And canceling an order and adding it has lots of nitty bitty little things that are so suboptimal compared to being able to amend single or bulk. So it's an API function that is on MEX and not on Bybit. And again, I'm not anti-Bybit or pro-MEX. I think they're all gangsters.
Brad's making the great comment that he and Austin asked me to let them know when I'm putting in BTC orders so they can counter trade me.
I often thought if I really wanted to make money easy, I'll just go on Twitch, charge people to counter trade me.
I swear I don't know what it is going on with us. We live in the same neighborhood, and when one of us is making a move, it's like the market is going the opposite direction. Brad will be like driving, taking his family someplace, and the market is going bonkers north. I could sell or reduce a position, and almost at the instant of keystroke is a reversion. This is my reversion finger. My if I sell, we revert. I think I'm right next to MTF and calling bottom reversions, except it's when I end up closing my position.
I'm not going to embarrass myself by telling you how bad I can be as a trader. but trust me, it's spectacular.
Yeah. Well, we do appreciate you sharing your insight and your knowledge and experience with us. Fred, have you got any closing questions?
Yeah, I have two more.
Go ahead.
So, do you actually look at what other traders are doing? So, do you try to spot other market makers and copy them or counter trade them, or are you just playing your own game?
It's not. I don't. Now there are, predatory algos out there, and so on that we can all see, and maybe they're probably the people that we're really moaning about when they're hunting stops and so on. But the spreads are so visible when you look at the order book. Okay, the question you have to ask yourself is, are they profitable? So, for example, when I started this, I would look at the spreads. You can clearly see them on the order book and go, well, this is easy. Clearly, these people are making money. And I couldn't make money with those ranges and spreads. So I ended up kind of having to do, and again, so I'm not predictive in the way my predictions are simply modeled on past historical price movement, which again is suboptimal. So I have tried to use and still messing with some neural networks. I can't get anything that would perform better than the way I'm doing it. But it is a constant thing here. Again, that the market's getting smarter. There's smarter market makers coming on board constantly, and you know, like any of us trading, you know, even the kind of market making I'm doing, it's, you know, this is a full-time job for me, and I just sit here trying to analyze data, and when I'm not, I'm in your excellent chat room annoying people. And I can be very annoying, as we all know.
We appreciate it there.
Not for long, you won't.
The last question I had was, you mentioned that market makers got wiped out during the COVID crash.
Yeah.
I was wondering how your system performed during the same time.
Yeah, I actually, to be honest, I really enjoyed it, because two things happened. My market makers pulled a hedge. That's fine, and maybe different than most market makers. When I pull a hedge, my algos just stop until I come and restart them, so they're not auto starting. And I made an absolute killing on the difference between mark price and I mean, I made a ridiculous amount on just the edge of the difference between mark price and index price. I mean, I was longing that thing 100x leverage with impunity. So the algos did what they did. I think they might have taken a small loss, because again, I would be hedged, but I love the move, because again, this is where people like me really make money, is not in predicting where the price is going to move. It's understanding the contracts and what circumstances will hand you free money. And these circumstances exist. And the COVID crash was it one trader already made 50 Bitcoin off just this deviation between mark and index price. Fair play. Love it. In fact, I think Arthur Hayes actually called him out and said he was delighted for it.
That's crazy.
Yeah.
A 50 Bitcoin trade.
Yeah, and here's the thing, with virtually no risk. This is the thing about it, right? Because he was on Twitter about it. I picked it up and went, geez, just like, wow. And again, understanding. And I know I kind of posted, as I do, this long, boring post about understand the contracts. And somebody rightly said, you don't need to know avionics to fly a plane. And I was going to respond, and I won't, but I'll do it now. And I go, well, no, this is more about the knobs and levers in the cockpit. So you kind of need to know those.
Well, for those of you who've been watching, we really appreciate you following along, and I'm going to apologize in advance for the rabbit hole that we just opened for you to dive into, because
there's a lot to digest here.
There's a lot to unpack here. I mean, we have literally just scratched the surface. But Shaun, I really appreciate you taking the time and being so generous with your knowledge and experience, not just here, but also in the community. Your content is consumed by a lot of people, and I think that many people look forward to reading your posts and getting your insights on things. So we appreciate your contribution.
And can I just say thanks to you guys? You're one of the only Telegram channels that makes any sense to me. And the way you look, and again, my interest is the way people look at markets, and not just you guys and kind of the mathematics. And I know, you're coming up with new stuff, but even what people like, again, the people in there look at markets differently. That's brilliant. We should all absorb that.
Mm-hmm.
Yeah, I mean, it has grown and continues to grow into just a phenomenal global community. Great place to share ideas, share insights, and gain insights. We literally have traders of all levels, from really fresh noobs to seasoned 23-year-old guys like you. And
if I told you my youngest child is older than that, okay.
Right. and we're all learning from each other. So, that's what the community is. And, for those of you who maybe haven't joined us yet, and you're watching on YouTube, you're watching on Twitter, we do invite you to check us out and join us, our global community of traders on Telegram. If you can't write down the link here, you can grab it from our Twitter channel at mi_algos. And if you appreciate the content that we are sharing with you, we hope that you will comment, like, subscribe, and share it. We are growing this thing, and it's been a phenomenal ride, but we're literally just getting started. Shaun, I don't know if you realize this. We actually just launched on September 30th of 2020. So this is a rapidly evolving deal for us, and we're excited to have this community support behind us and guys like you in it.
Definitely.
All right. Thank you.
Say it again.
Thank you very much. I guess we're all anxious to get back to Bitcoin.
Yeah, let's do it. Fred, get back to work, man. I need you to start doing some stuff.
All right.
Hey, thank you all. Thanks again for watching. And you can engage with us, of course, in the Telegram channel just about 24/7. Our crew is both in the US and in Europe. So we cover pretty much, we don't have many gaps in time zones. So we hope to see you in the Telegram channel. And of course, you can learn more about what we're doing. The link to all the descriptions is in the link is in the description to everything we've got. So look forward to seeing you on Telegram. And Shaun, have a great weekend. Fred, you too. We'll talk soon.
All right. Bye-bye.